A central bank's job is not passive. It does not simply watch the economy and hope for the best. It has active tools that it uses to keep the economy on an even keel. In this video, we explain the central bank's primary monetary policy tools and how they work. The first tool is the policy rate. This is the interest rate that the central bank charges when it lends money to commercial banks. Think of it as the starting point, the reference rate from which the entire financial system takes its signal. When the bank raises the policy rate, banks pass that higher cost onto businesses and households. People borrow less money circulates. When the bank lowers the rate, borrowing becomes more affordable. Credit flows more freely. Businesses invest. Households spend. This is how the policy rate acts as a signal, not a command, but a powerful influence on the entire system. But how does the bank decide where to set the rate? It looks at the full picture: inflation trends, movement in the exchange rate, global commodity prices, credit conditions in the economy, and what is happening in the wider world, from shifts in major trading partners to geopolitical development that could affect Ghana. All of that gets weighed, and then the bank sets the rate it believes will best keep the economy on track. The second tool is liquidity management. Liquidity refers to the amount of money flowing through the banking system at any given time. Think of money in the system like water flowing through a pipe. When the flow is balanced, the economy functions well. But when there is too much money in the system, more than the economy needs, prices can start to rise. Inflation builds. The central bank's job is to manage that flow. One of the main ways the central bank does this is through open market operations, or OMO. When there is too much money circulating, the central bank steps in and absorbs the excess, drawing it out of the system and holding it safely. The excess money is taken out of circulation. The pressure on prices eases. The third activity is building the country's external reserves. Think of reserves as Ghana's national savings, held in foreign currencies and internationally recognized assets. They are the buffer that protects Ghana when global conditions deteriorate, when import prices spike, when the cedi comes under pressure, when foreign financing dries up. Strong reserves give the country room to respond without panic. So much money in the system is war. The central bank holds and manages these reserves on behalf of the country. How it does so is guided by internationally recognized principles, the kind endorsed by institutions like the IMF and the Bank for International Settlements. When central banks manage their reserves, they are guided by three principles. First, safety. Preserving capital is the priority. This means holding a well-diversified portfolio of high-quality assets so that risks are well managed, not overly concentrated, and balanced across assets that behave differently under changing market conditions. Second, liquidity. Making sure the funds are available and easy to deploy when needed. Third, return. Earning a reasonable return after safety and liquidity are ensured. Together, they are how the bank executes monetary policy.